Hi, this is Drew Tignanelli, and this is our October webinar. I got my associate, Bob Boehner from Gettysburg with us. Robert, great to have you.
Great to be here.
Yeah, up there with Dwight Eisenhower, having a good time in Gettysburg. We're going to do 10 reasons why a comprehensive personal wealth and tax advisor saves you more than a tax preparer. So, Bob, you were what? 40 years, and your father was, and your grandfather was a tax preparer, right?
Correct. My grandfather came down from New York City. He was an auditor, and he was auditing manufacturing companies down here. He loved Gettysburg, so he decided to move down here. And then my father followed in his footsteps, public accountant here in Gettysburg, and I'm the third generation.
But they did tax returns also, right? And they taught you how.
Oh, that's what they, yes, they were tax preparers. That was the primary work that they both performed.
And after 3 generations of being a tax preparer, when you joined the consulate, did anything change?
Yes, a lot changed. I'd like to think that when you look up tax preparer in the Gettysburg dictionary, you'd see my picture. When you look up comprehensive personal wealth and tax advisor in the Hunt Valley dictionary, that there'd be your picture. So I was very excited when I met with you about 7 years ago and heard how you prepare tax returns in a comprehensive manner and tie it into financial planning. It was exciting. So it's night and day, and we'll get into that. But yeah, I'd like to think that my firm grew from 3.5 employees to about 14, but we were good tax preparers, but we were not comprehensive planners and tax preparers. And that's what I've been learning the last 7 years, is how to increase the.
It's logical, Bob, because, a tax preparer, they're trying to do 3, 4, 5, 6, 7, 800 returns. You got to get them done. And people are throwing information at you, and you've got 3 months maybe at the best. And even if you put them on extension, you still have to wait for the client to get the information. You're still constantly, and you're just trying to get the data into the tax return. That's not
Correct.
what a tax planner does, and that's what we're going to talk about today, right?
Exactly.
Great. Let's go. Ready? Oh, it's the same 2 guys,
Hey.
And
what we lack in hair follicles, we have in years of tax experience.
and I think we were both younger when we took those pictures. So anyway,
yes.
So we're talking about the difference between a tax preparer and a professional comprehensive advisor doing tax returns, and that's what you're doing now. And what would you say your revelation is the big difference between the 2?
Well, just trying to think, in addition to paying the least amount of tax from the tax data provided by the client, the taxpayers, what other things could the taxpayer do to reduce their tax liability that they haven't already done, but there's still time to do? And
not just reduce your tax liability on this tax return, but reduce it into the future also. So,
sure. Yes.
We're now doing lots of things, encouraging our clients to increase their 401ks, do Roth IRAs, do tax Roth conversions, and we're going to go through a whole bunch of other things. And it wasn't that you were an excellent, and you still are, an excellent tax preparer, making sure the data is in properly and the information comes out properly. But what you do now is, when you see that W-2, your eyes and ears and your brain is thinking about things that we've taught you over the last 7 years as to how to go back to the client and say, we may be able to do this. We may be able to do this. We could do this next year. If we do this, we're going to be cooking with gas,
Right. And there's probably 30 things we could talk about, but we don't have time. So we picked 10 that we thought the listeners would want to hear about.
And, I would also, before we change this, I would say that 99% of people who go to tax preparers expecting that they're doing what a professional comprehensive advisor does. But they don't, they can't. It's not what they do. It's they don't have the time to do it. They're too focused on getting all that information in the return and out the door as quickly as possible, right?
Correct, right.
And the clients aren't paying them to do tax planning and comprehensive advisory work. They're paying them to get the information from A to B and to the IRS or to the state of Pennsylvania or Maryland or whatever state you're in. So
right, and along those lines, Drew, yes, we would in the fall, as tax preparers, we would meet with clients to try to do some tax planning, but we weren't doing it for every single taxpayer because we didn't have the time or the information.
Right. So, okay, here's the first one, right? So when I look at a tax return, I'm doing number one, you're going to do two. So I'm doing the odd because I'm odd and you're even. And so we're going to do the first one. And when I look at a tax return, boom, my eyes immediately look down at how many capital gains, what interest, what dividends, why is it there, where's it coming from, what brokerage firms, what banks, et cetera, and are there better things that they can be doing? They're just not aware of it. And you know, most people are working with stockbrokers and bankers who don't know the first thing about tax planning. They don't want to know the first thing about tax planning. They sell investments, they sell banking products. They're looking to make money off the clients. But a comprehensive professional tax advisor and wealth advisor looks at those things and immediately thinks, why are they there? Are they logical they are there? Is there something better we can do? And, you know, just give you an example. A lot of interest income, you know, if you can find a great municipal bond investment, and most people think you just go buy a tax-free municipal mutual fund. Not true. Mutual funds, heavily invested in bonds, could be one of the, you could say that the income's tax-free, but it may not be a great investment. We almost always, when we see this situation, we want individual municipal bonds, and we want very specific, logically chosen by some of the top municipal bond people we can find. And there's a reason for that. We don't have time to go into everything, but that's one thing we're looking for. Also, when we see capital gains, it's probably because they have an active mutual fund or somebody's actively trading stocks for them, and those capital gains are adding up. And the question we're going to ask ourselves is there incredible investment wisdom going on here, or are they not even doing as well as an index fund? And if an index fund is doing better, I want that index fund because I won't pay nearly as much in capital gains, because index funds do not create capital gains, especially ETF index funds do not create capital gains that are passed through for you to pay taxes on. Number one. Anything?
Yes, in addition to that, not only are you reducing their tax liability, but you're improving their investments at the same time. So
most people don't even realize that, Bob, that they're paying all these capital gains, they own these mutual funds, they think they're doing wonderful, but really they could have made more money with an index fund and they would have paid less in taxes on it. So very important lesson. Absolutely.
Right.
Go to number two, Mr. Even. Go ahead, take it away.
Okay, maxing out your health savings account. This is one of the things, Drew, that you really concentrate on, and it really was an eye opener to my staff and myself about the health savings account is a triple tax advantage item, and not only the tax savings. Many employers will get you kickstarted with a contribution to your health savings account. So that's a fourth benefit, but it's pre-tax, so it reduces your adjusted gross income. It's allowed to grow tax-free in the account. And then when you take it out, it's a tax-free distribution if you use it to pay medical expenses or reimburse for medical expenses that you paid out of pocket.
Right.
So it's just, it's a fantastic opportunity, and it has to be a high deductible health plan. But I think I read today that 46% of Americans have high deductible health plans. So they're more popular than they used to be.
So
But we need.
let's clarify though, okay? A health savings account is not a flexible spending account. So
Correct.
a lot of people have a flex spending medical account, okay? And that's a limit of $2,700 a year, and you can carry over 500, and you got to use the rest before February, 27th or whatever.
Yeah, use it or lose it.
Yeah, this health savings account for a single person is $3,600 a year. For family, it's $7,200 a year, and it's cumulative. It doesn't matter if you use it or not, it just keeps accumulating every year. Totally different. They're totally different critters. And you're right, you have to have a high deductible health plan to have a HSA. But here's another thing, Bob. When you're doing the tax return and you look at that W-2, you know all the codes on that W-2, right? And immediately you see box 12, code W, that's the health savings account. And you know they're single, they could do 3,600. If they're over 55, they could do 4,600. And you see only, let's say they're 58 years of age, and you see code W, $2,800, right? You're immediately, my mind says, boom, get that client to put 1,800 into the HSA before April 15th, because you're allowed to fund an HSA before April 15th of the following year. I get the tax return in the W-2 before April 15th. I see it, boom. I'm after that client to put the last 1,800 into that HSA.
Right. And then of course, we want to encourage them the next year to do it through payroll,
because they
get additional payroll taxes.
Yeah, right. What he just said was they not only get the federal and state income tax deduction, but they also get the FICA tax deduction when it's done through payroll, right?
Right.
So if they didn't do it in 2020, and I'm looking at that 2021 W-2 before April 15th, I want them to put the lump sum in. But then, like Bob just said, I'm going to encourage them to increase their payroll deduction. HSA, one of the greatest benefits, but tax preparers don't have the time to tell you about why you should work with this and how to get it done. This, the good stuff.
Well, yeah, and I think the other thing we're thinking as tax preparers is if they wanted to do it, they did some. If they wanted to do more, they would have. And so we would have just done the return without talking to them. But, now we know it's better to talk to them about it.
If you had the time to be a tax preparer and talk to people at the same time, then you're not being a very good tax preparer. Anyway, number 3, 401k, IRA, and Roth contributions. So what we're talking about here, again, I'm looking at that W-2. I instantly see box 12, code D, code E, code AA, code BB, code G, code CC. Any one of those is immediately saying to me 401k, Roth 401k, 403b, Roth 403b, 457, Roth 457. That's what I'm looking at. That's what I'm seeing when I see that code D in box 12. And immediately I know this client's under 50 years of age. Their max is 19,500. They only put in 6,000. I want to know why. I want to know what they can do to increase it. And, here's the really cool thing, Bob. Let's say I've got a client that in the state of Maryland, and let's say that their income is falling in at the 152 range. Well, I know that Maryland has this funky cliff vesting at $150,000, right? And I know that this client only did 6,000 in his 401k pre-tax. If he would have done 3,000 more, his income would have dropped down to 149. He'd have been under that cliff vesting of Maryland's exemption phase out. And boom, we would have picked up, let's say he had 2 children. So it's 4 people. They would have picked up for $5,600 of extra Maryland income tax deductions. That's equal to about $500 in tax savings over and above the income tax savings and the the income tax savings that they would have picked up. So for like a $2,000 or $3,000 contribution, they literally could pick up something like $1,000 in tax savings. That's like a 50% tax saving. I see that when I look at that W-2 and I see what they're putting into their 401ks and 403bs. These are the kind of things that a great comprehensive tax advisor does. And this is the kind of stuff that you've been picking up on now and learning and doing a great job with. But then you also have the IRA and the Roth. So I know that the spouse who's not employed in a job that has a 401k or a 403b, and the family income is under 198,000, I know that that spouse can do either a deductible IRA or a Roth IRA. And now my job is to help them understand why they should do it. So let's go back to that same Roth scenario. I once had a client, you ready for this? I once had a client that had $150,800 of income, okay? 2 children, state of Maryland, okay? I knew the wife didn't have a 401k plan where they worked. They didn't have any pensions. And I knew the family income was under 198. I put $2,000 into the to the traditional deductible IRA for that client, and they got $1,300 back on their tax return. I mean, think about that. That's like a 70% tax bracket. Just that, but I knew that if I dropped their income down, I was going to pick up 2 big things. One, the Maryland tax benefit. And then the other one was just the income tax savings on that. But because that income was so low compared to the cliff, and people don't know what I mean by a cliff. What I mean by a cliff is if your income is $150,000, your adjusted gross income is $150,000, and you have 4 family members, 2 parents and 2 children, Maryland just, boom, takes $5,600 away, right? $5,600 goes away. Why? Well, because they say because your income was 150,000 or more, you don't need it. Don't phase that. No, like, hey, if you make 152, you're going to lose $200. And if you make 160, you're going to lose $2,000. And if you make 180, you're going to lose. No, it's 150 or more, boom, it's gone. And I realize that. And so I look and I think, okay, this one doesn't have it. I know I can do this, and I know I can do that, and I know I can do this. And I want to make sure they get every dollar they can. I see interest in their bank accounts, and I know that that's got to be $25,000, $30,000, $40,000, $50,000 because the interest rate on those accounts is so low. And I'm saying they're eligible for a Roth 401k, and they haven't been doing Roths. This is the first year working with us. They haven't been doing Roths. So I'm pounding the table. I'm calling them up. Somebody in my company is calling them up saying, you got to do this. Don't tell me you're not going to do this. If you're not going to do this, you're not working with us long term because we just can't handle it. If you're going to not take our advice, and there's no detriment whatsoever to do this. So
right.
Number 3.
That's a good one.
Ready? Go number.
Okay. Number 4. This is a fun.
I'm looking for my mouse. There he is.
IRA, RMDs and qualified charitable distributions. This is just it's just fun to save clients money. So we have clients that come in and they are making some donations to the church, and they have a small IRA or a medium IRA, and they're just taking their RMD, depositing it in their checking account, and then they're writing checks out to their charitable organizations. Well, we tell them what you need to do is do a qualified charitable distribution where you tell your IRA administrator to send your required minimum distribution, or more if you want, straight to your church or to the American Heart Association, whatever qualified charitable organization. And that reduces your income. And especially with this larger standard deduction, very few people were itemizing. So you're not getting a benefit from writing a donation check. So you're killing two birds with one stone with this one method.
Right.
And the other, another benefit, and we've even seen this with smaller incomes and smaller donations and smaller RMDs, is you have some folks that they make just enough that a little bit of their Social Security is taxable. So if they'll do the QCD, that brings their IRA income down. It reduces their taxable Social Security so that they can save quite a large percentage of taxes just based on that decision to do the QCD as opposed to the old-fashioned two-step process.
Yeah, I had a guy call in on the radio last night just about this, and he said, well, I do itemize, so I'm not doing the QCD. And I went on for at least 5 minutes and trying to persuade him, do not make that mistake by thinking that just because you are itemizing, you don't need to do qualified charitable, because like you just said, there are all these little landmines on the tax return. And if your income's over this, all of a sudden Social Security becomes taxable. And if your income's over this, Maryland takes away these exemptions. And if your income's over this, you lose this. Or if you do this, then you lose more medical expense deductions that you had. And the list goes on and on and on and on.
Right.
And so anytime you can reduce adjusted gross income and still get a deduction for it, you want to be doing qualified charitable deduction. I could go on for a long time as to why this is a absolute, and at the very least, you should at least test it and say, if I would have done a qualified charitable, what would my tax liability been? If I don't do it, would it be more or less by doing it, as an itemized deduction? I have not yet found one that worked the other way.
Right. And your radio caller, if he's itemizing, maybe he has medical expenses. So this would give him a larger medical expense deduction.
Well, what if he's doing a lot of charitable, Bob, okay? And he's just getting over the standard deduction by $2,000 or $3,000, but he was doing like 10. So the first 7 is after tax money. It's only the last 2 that he's itemized, and he's missing $7,000 of deductible by just doing qualified charitable. This is an amazing benefit, and when you do have to be over 70 and a half years of age, and it's literally your 70 and a half birthday. And don't even think of asking me why 70 and a half. I don't know. I don't make this stuff up. I just memorize it, Bob,
Right. Well, and the other potential benefit, and this wouldn't affect a lot of people, but if they're right at a certain point where their Medicare premium might be going up because of their income, this IRA, RMD, QCD might save them something a month on their Medicare premium.
Another landmine. Well. That's another cliff landmine. $1 over 178,000 married, or 88,000 single, or 86,500 single, or whatever it is. Boom, you're going to pay a lot more in Medicare Part B premiums. It's cliff vesting. It's not a phase in over a period of time. You still do need to get a receipt from the charity that, even though you can prove that you gave a check from your IRA direct to your church or your hospital or your medical research facility of choice, you still need to get a receipt that says, I got this check from you, no goods or services received on this day, right? Very
correct. Yeah, and the organization, they should know that they need to provide that receipt.
That's a good one. Very good. Roth conversions, understanding when. This is an odd one, Bob, so I'm Mr. Odd, right?
Yes.
Roth conver- That's not a good answer, Bob. Saying that the boss is odd. Roth conversions, understanding when. You know, you get a lot of people, I hear a lot of people say, you got to convert everything. You know, well, I'm like, you know, I'm not going to convert everything. I'm not going to just tell a client to pay oodles and boodles of taxes just because I feel that rates are going up in the future, because I don't know what the future holds. I want to do it strategically. I want to do it smart. I want to think about when to do it. I want to know how to do it. You know, and so we're right now in the midst of doing Roth conversion analyses for lots of our different clients. And that's every year. And when we do the tax return, we're sitting there saying, this client needs to be doing more Roth conversion. They didn't do enough last year. Or, you know, you get a new client in, you say, gosh, I wished I would have had this information last year, because if I did, we could have done a heck of a Roth conversion. So I mean, how many times do you see somebody who, you know, they live modestly, they have IRAs and so forth, but they just don't need to draw against them, and at the end of the year, their income comes in negative. Well, what a shame that was. I want their income to come in just positive, and I want to take enough money out of the Roth, out of the traditional IRA, move it over to the Roth tax-free. Or say you had a client that had a bad business year and they get a big loss in their business one year. Well, I know that that loss is coming up. And I say to the client, hey, you had a big loss this year. Let's turn lemons into lemonade. Let's take that big loss and let's convert over a bunch of money to Roth IRA and eat that loss up with all this taxable income. And I see too often, matter of fact, we had a client that came to us, they had a big net operating loss, and year after year, the tax preparer was just letting that net operating loss sit there and get devoured. And, you know, every year they did that, they lost all their standard deductions, et cetera, every single year. And yet, what we would have done, we would have gone in, we would have taken a giant bunch of IRA, we would have converted it to Roth, ate that whole net operating loss up, and voila, you know, we would have had a monster tax-free conversion. And that's when IRAs really work for you. When you can get them out of IRAs at extremely low tax brackets and over to Roth, especially zero brackets. And we're going to talk about a little strategy later that you put these two together, this one coming up and this one together, and you got a slam dunk strategy there. So Roth conversions, don't just do them. Make sure you understand how. I give you another one. We just had a client that moved back from Florida to Maryland. Okay. And before she moved, I said, I know you're coming back to Maryland. You got all friends here and so forth. You're getting older. You want to be here in Maryland. I said, let's do this. Let's just take a big hunk of your IRA and convert it while you're state income tax free. And then next year, when you're in Maryland, you know, you'll be paying taxes, but you have all this money state tax free already converted over to Roth before you come back to Maryland. And it was a beautiful strategy. I live in Florida now, and I can assure you one of the strategies I have on my agenda is to start doing Roth conversions and paying the taxes on it. There's lots of other ways we could do this. So.
And Pennsylvania also does not tax retirement income, so we can do that up here without a state tax.
Yeah, you know, that's a great thing that anybody in Pennsylvania should be thinking about, Roth conversions, if they're intending to leave Pennsylvania in the future, especially. All right, you're Mr.
Donor advised funds and bunching of your itemized deductions. Well, these are similar processes to take advantage of itemizing in some years and taking the larger standard deduction in other years. The beauty of the donor advised fund And we've done this with clients, drew together. We have a very charitable client, and he gives maybe $25,000 away a year. And we decided that he was going to give 2 or 3 years worth into his donor advised fund to take advantage of his maybe final highest income years from a job that he was leaving. The donor advised fund, the nice thing about it is you only have one receipt to worry about. And then you can direct where those funds go to what charities, and you don't have to worry about all those other receipts because those receipts don't matter. It's what you put into your donor advised fund.
You can also give anonymously too.
Exactly right. So you go into the fund and you tell your, say it's Fidelity, please send this donation to this pregnancy center or to that church or that fire department or all of those, and they'll send it. And you may get receipts, but you don't need them for the IRS. The other nice thing is that the fund can grow, and you don't have, there's, as far as I know, Drew, no time limit. I mean, those funds can sit in the donor advised fund waiting for the allocations to your charities as you see fit over time.
Well, you can sit, and there is technically no time limit, but there is some provisions that, like Schwab, will be sort of aggressive if after 5 or 6 years. We had a client that was sitting on an account, hadn't done anything with it, and they were starting to say, what are you doing? What are you doing? And I said, well, the account was set up for when she passes away someday, and then it'll have $1 million in it. So don't worry. And they said, oh, okay, that's fine. But yeah, there's no real time limit, but you do need to use it somewhat.
Right. And the bunching is just if for some reason folks don't either want to bother with the donor advised fund, or they don't think their donation is large enough to merit a donor advised fund, they may want to, put their donations in every other year or every 3 years just to take advantage again of that larger standard deduction.
Right.
So just 2 little strategies that taxpayers can use.
But now, see, the thing that a lot of people, you and I understand this, but I'm not sure I'm going to explain this really well. But let's say you have no mortgage and you give $10,000 a year away, typically to charity. Okay. So, and you're married, right? So you can only take $10,000 of taxes, assuming you have no medical deductions, you have no mortgage. So the only other thing you can take is charity, right? But you're only doing $10,000 a year. So $10,000 of taxes, $10,000 of charity doesn't get you over the limit, right? So in essence, you're losing all of those charitable deductions every year for the next, let's say, 5 years. It's $50,000 will all go out after tax under the current tax law. Okay. Now, let's assume though that Bob comes in and says, let's take appreciated stock that you only paid $10,000 for, and let's put it into a donor advised fund worth $50,000. I'm going to get you a deduction for $50,000, even though you only paid $10,000, because that's one of the beauties of appreciated stock going into a donor advised fund. We're going to do it all this year. You're going to get just one receipt from the charity, so you don't have to worry about it anymore. Okay. And now all of a sudden, what just happened? Now the first 17,000, let's say, if you're over 65 years of age, the first 17,000 is after tax, because you got to get up to 27,000. But after the 17, the next 33 just became tax deductible, and bam, you got $40,000 of capital gains that you never paid taxes on. You got a deduction for $33,000 of extra tax deduction that you wouldn't have gotten if you just kept going along the way you were going. And I could take that extra tax deduction I'm getting, I could go back to slide number 5 and say, let's do a Roth conversion on that money. Instead of just getting more refund, let's use that refund to convert 33,000 over, and boom, they'll offset each other, and bam, I'm in the exact same place it would have been, but now I've got 33,000 tax-free, in essence, over to a Roth IRA. So these things are really cool, but you have to think about them. The tax laws are so complicated, you need somebody thinking about these things. Number 7. That's odd, right? Don't say it.
That's odd, but you're not. Take it away.
7. SEP versus individual 401k. So we see this all the time. Client comes to us, they got a small business, they're making 30, 40, 50, $100,000 a year in their little Schedule C business. Maybe they're a consultant or something. And, you might have had a tax preparer out there that said, hey, you could do a SEP IRA. It's real easy. You just sign this. Or maybe they had some salesperson, financial planner type person, says, hey, we can do a SEP IRA, da, 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 and, off they go. But there's a critter out there, Bob, a critter. Now, I'm from Pennsylvania too, and that's where I picked that up from. I'm from Erie, Pennsylvania, but I was only 3 when I moved to Maryland. So, but my parents were Pittsburghians, and I guess critter is a way you said that in Pittsburgh. Well, anyway, there's a critter called an I-401k, an individual 401k. Some people call it a solo 401k. There's lots of different terms for it, but what it means is a 401k plan for a company where the only employee or the only worker in the company is the owner or the owner's wife, or I should say the owner's wife. And if you have that unique situation where it's just you or you and your spouse, only people in the company, no other employees, nobody else could participate, you can do what's called an individual 401k. And in an individual solo 401k, or whatever you want to call it, you can still do the full $19,500. If you're over 50, you can do the extra $6,500 catch up, $26,000 plus the same SEP contribution. And hear what I just said. So somebody who's doing the SEP gets approximately 20% of their business income, okay? And it's technically it's 25%, but when you do the mathematical formula, what it's actually the law says, it's technically about 20% of the business income. So that's what you're going to get with the SEP. With the I-401k, if my income's at least 26,000 or more, the first full 26 I can take. So somebody who makes $30,000 in a small business using a SEP can do about $6,000. In an I-401k, somebody who's making $30,000 could do $26,000. I mean, technically, we could do $28,000. Now think about that. A SEP, you only eliminated $6,000 of the income. In an I-401k, a $30,000 business a year, I could wipe out almost the whole entire thing. And if the client's making, let's say, $150,000, in the SEP, you can do about $30,000. In the I-401k, I can do $56,000. In the I-401k, I can do the $26,000 employee contribution. I could do it either pre-tax, or I could do Roth 401k, after tax, growing tax-free. And there's benefits to doing one or the other. Matter of fact, under the new rules of QBI, qualified business income, I want to do the Roth typically. The default is going to be to do the Roth and only use the SEP portion if I need to drop below some breakpoints on the, like the Maryland exemption, the Medicare exemption, and the AOTC. We're going to get to that in a second. The reason a lot of people don't do the I-401k for clients is that most salespeople don't understand it, don't know it exists. But even if they did know it exists, it requires some extra understanding, and it requires an extra filing every year of a form 5500 or 5500 easy. It's a relatively straightforward form, but most salespeople aren't going to file that form. They're going to tell the client to go to their accountant, get the accountant to file. The accountant's going to charge them $500-600 to do it. And, and so they figure it's easier to just do a SEP, but that's not what's best for the client. That's what a professional comprehensive advisor does. All right, back to the even.
Number 8, 529 plan contributions, even if you need it yet this fall. So 529 plans are a wonderful opportunity for parents or other relatives to put away some money for their children or grandchildren or niece and nephews' education. And you can invest in the fund in any state in the country, just about. You don't have to invest in a PA 529 if you live in PA. Your kids don't have to go to a Pennsylvania school. These 529 plans will accumulate earnings that will be tax-free when used to pay for either private school or college or trade school or whatever expenses you're incurring that are eligible. Now, a couple of the nice things about the 529 plans, Maryland and PA both give you a state tax deduction for the plan contribution up to certain limits. And so you not only have tax-free earnings inside the plan, but you have a state tax deduction. Now, the other nice thing about this is, for example, if you have a new client comes in, or a client comes in and they tell you they'd like to help their grandchild, and you could put the money into the 529. They could put the money into the 529 plan for their grandchild, and then take the money back out that was spent last semester. So as long as you have those legitimate expenses, it doesn't have to necessarily be consecutive. So for those folks who have fall bills, well, I guess the fall bills have already been paid, they could be used for those expenses. And then some schools bill in December for this January semester. These funds can be contributed and taken out, within days to reimburse or pay the tuition bills or room and board fees for institutions for, children, grandchildren, or whatever.
And still get the state income tax deduction.
Correct.
There's no requirement that it sit in that account for years and years and years. So, like you say, I've got a grandchild going to college, and I want to help my children and the grandchild pay for that college. And maybe they've already paid the tuition, but I want to give them something back. So I could put 10,000 in, take 10,000 out a week or two later, give it to my children. And as long as I can prove that they had tuition, room and board, or other expenses, I gave them the same 10,000, but now all of a sudden I'm getting $800 back on my Maryland income tax return, or I'm getting $400 or $500 back on my Pennsylvania income tax return.
Right. Well, I think originally we would think, well, get these plans started when your children are young so that they can grow and help you in the future. Well, that is true, but like you just said, we can take advantage of these 529 plan contributions now for kids that are paying their expenses this year and as they go. So there you go.
Yeah, 529s, you don't even have to let them sit in there to get some advantage out of them. You can put it in, take it out a few weeks later. If you have bills that for that child for education that have been paid during the course of the year, and get on some states, not every state has a tax deduction, Bob, but Pennsylvania and Maryland do. Like, I live in Florida, so for me to put it in and take it out in a Florida plan is ridiculous because there's no state income taxes, there's no state tax benefits. But if I lived in Maryland, I used to do this when I lived in Maryland because I had a grandchild going to K through 12. And I used to put the money in, take it out, give it to the parents, and they'd pay the tuition. And I got money back from the state of Maryland for doing that. That was a great gig. So anyway, it's a great strategy. Number 8. Number 9, phase out like the American Opportunity Credit or tax landmines like the Maryland exemption or the Medicare B surcharge. We've already talked about these to some degree. But let's talk about this American Opportunity Credit, okay? So, Bob, I get a client come in and they've got 2 dependents. One's a college student and one's going to be a college student soon, right? But their income is $250,000. Well, you and me both know you got a college student, you're paying $35,000 a year in tuition. The kid, and you're making $250,000, or even worse, let's take it up even a notch. Let's say the parents are making $550,000. It really doesn't matter. They're over the limit for the American Opportunity Credit. The reason I take it up over 500,000 is they're not even going to get the tiny little $500 tax benefit for the kid that's under, is still your dependent in college. You get $500, that's cash that they'll give you as a credit back for that kid, okay? But if you go up over 500,000, you're not even getting that, right? But you're still taking the kid on your tax return because that's what you've always done. And that's what the taxpayer says. Well, he told me that he's a dependent, But here's the cool thing, okay? I can figure out, can I get income into the hands of the college student, okay? And if I can get enough income into the hands of the college student, I can take that student off of the parent's tax return and flip them onto their own tax return, pick up the American Opportunity Credit, and going back to that health savings account, if the child is still on the parent's medical insurance plan, but no longer on their income tax return, I can now fund even more money into an HSA for that child. And boom, I pick up the American Opportunity Credit, which is $2,500 of cash. I pick up an HSA health savings account, which could be as high as $7,200 more dollars saved into an HSA on behalf of Joni or Johnny or whatever kid you have going to college. And I mean, but you wouldn't know this unless you know this. That's like the Yogi Berra saying. You wouldn't know it unless you know it, And you need to know this. It's important. Tax preparer is just going to get the tax return done and say, well, you had tuition, your income's too high, end of the story, right? That's what you would do. But a tax advisor says, wow, I had a client just recently, guy owns a business, right? And I said, Joe, if you could pay those children $30,000 a year, I could make that income 100% tax-free, and I can get an HSA in each child's name, a health savings account for $7,200. Do you think you could do it? Now, the children have to work. They have to have a legitimate job. But keep in mind, what I can argue is worth $30,000. The average person might think is ridiculous, but you can argue it. You have to have a legitimate argument for it. For example, let's say I had two children and, and I decide, I'm going to put my children's pictures on my website instead of, buying them from some stock photo company or whatever. Well, I mean, I can prove that there are companies out there that charge $5,000, $10,000, $15,000 a year for the use of those photos of those individuals. And, I could get the child to do things on my website, and I could give them, could you modify that? Well, I could prove that there are companies out there that will charge me $50,000 a year to be on retainer to update my website as I desire. And I could easily prove that these things, which maybe the child's not doing an extensive amount of work on, but they're providing the same service somebody else says they're going to do at these rates, I can prove that that's the rate that I can pay. These are incredible planning opportunities. You just need to know the law and see the machinations that need to be done, and can they legally be done? And that's always the issue. You never do anything that's not 100% legal. I'm all for gray. In other words, the law doesn't specifically say you can or can't do it, but it's clear enough and enough people are doing it that it's fine. Now, there are plenty of things that I've realized people are doing, and I think it's a charade, and I don't do it, and later it blows up with the IRS. But there are plenty of things that are in the gray like this, where, you know, you could say, you know, we just have to be able to defend it. It's perfectly legal. We just have to be able to defend it. And
Right.
great strategies. Last one, Bob, you're number 10, but we're doing
Number 10.
Go
I'm
ahead.
going to share this one with you. So real estate investments and section 1031 and section 1031 to the Delaware Statutory Trust. So from time to time, we'll have a client might have a rental property and they just want to get rid of this rental property, but they've had it forever and they don't want to pay the taxes on the gain. So they ask us what are their options? Well, one of the options would be a section 1031 exchange. They could exchange that rental property for some other real estate or investment in a Delaware statutory trust. The section 1031 exchange just defers the tax to a later point in time when the subsequent investment or property is sold. It doesn't eliminate the tax, but it does defer it, which might be beneficial to a time period when a client thinks they'll have a lot lower income and a lower tax rate. Drew, I'm going to let you talk about the Delaware Statutory Trust. I think you have more experience in that area.
Yeah, so like you said, you got clients that own real estate, and especially as they get older, you know, and I talk to clients about this a lot, Bob. You're now 65, 70 years of age, and you've got 6 or 7 or 10 or 15 or 20 rental properties, and you're doing them all yourself. It's kind of like your hobby. Well, that's great. But what if you become disabled? What if you die? Who's going to take care of this? Are your children ready to step in? And if they are, then that's great. Let's keep going. Let's get more, you know, because the next generation is willing to take this on. But you know what they normally say is nobody's interested, you know. They all got their own busy lives and careers and children and so forth. They're not interested in running. So what are you going to do? You know, well, I don't want to sell them because if I do, I'm going to pay a boatload in taxes. And they're absolutely right. Because when you buy a building for $500,000 and you hold it for 20 years and you depreciate it and depreciate it and depreciate it, now you're going to pay gain on pretty much everything over, let's say, $200,000. So you sell it for $1 million. You don't just have a $500,000 gain. You might have an $800,000 gain, because that's the way real estate works when you depreciate it year after year after year over long periods of time. So in steps the Delaware Statutory Trust with the section 1031. Delaware Statutory Trust is where lots of people come together in a trust called a grantor trust. And that grantor trust then goes and buys a piece of real estate for a large sum of money. Like we just did one not too long ago into an Amazon distribution center. And I think they brought like $25 million in to buy that distribution facility. And there were a whole bunch of people who put in $200,000 like our client, or $500,000 from the sales of real estate properties in a 1031 exchange. Now, 1031 exchange in and of itself is a complicated little thing that we could get into that another time. But the beauty of this was deferral of a piece of investment real estate. And Bob, it doesn't have to be a rental property. We had another client that just sold a land for a couple $100,000, a lot they had bought. It was like 5 or 6 acres, and they were being offered $200,000 for it. And they sold it. They had only paid $30,000 for it, and they rolled it over into a 1031 exchange into a Delaware statutory trust, deferred all the gains. They're getting 4 to 5% dividends per year from the rental of the properties that the trust bought into, and they have the appreciation potential, and it's all fully tax deferred into the future. These are the cool things that you can do, that if you know about them, a tax preparer is not going to be taking their time to talk to you about these or even think about them. If you ask them about them, they might know about them, but most tax preparers spend most of their time trying to keep up with the laws and software programs and things like that.
Right.
They're not thinking about the tax planning strategies. So I think we went through 10 good ones. And look, there they all are. 1, 2, 3, 4, 7, 8, 9, 10. And there's many more. We could have probably done 40 or 50 of these if we wanted, but I don't know that we have any more time to do any more. So we'll just wrap it up here. I hope that people find this beneficial. I will say that that last one, the 1031 exchange with the Delaware Statutory Trust, that's one that there is proposed tax legislation that could nix that whole thing. So we have to keep that one, you know, holding it gently until we find if they're going to pass this tax law. This is October 2021. So if you're thinking about that strategy and it's after 2021, make sure you ask somebody like us, is that still a viable strategy? All right, Robert, thanks for that was a great job you did, buddy.
Thank you, sir. And
All
you're
right.
not off.
We are finished.
Take care.